And I ask a lot of people who complain about what's going on, and rightly so, is what would you do different? Are you going to default on all of the baby boomers and destroy their pensions and then destroy the entire economy? Or do you let all of the system go under because you don't have any assets? It's very difficult to actually come up with an answer that is reasonable. They're all shit. They're all shit answers. So maybe the least shit is 8% a year.
Bitcoinzilla stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoinzilla today and enjoy the new edge. Raoul Pal, who accurately predicted the 2008 financial crisis, explores the key differences between the 2000 and 2008 crashes, the importance of decentralizing power, the role of AI, and the need for fostering genuine human connections through communities in a rapidly changing world.
But if everything is being driven by this one dominant factor, which is debasement of currency, and your hurdle rate is, let's say, 8% debasement plus 3% inflation or something, 11%, call it 12% for easy maths, on a globalized level. So unless you're making 12% returns, you're not going anywhere. Then at Exponential Age Asset Management, the asset management firm that I co-founded, we have this table of all of the different assets. And basically, the S&P is about 12%. So owning equities, which is why all of the millennials who have 401ks and they put it in the S&P still can't afford a house because they're just matching the debasement. They're not beating it, right? So they're not getting paid for locking up money for extended periods of time. The NASDAQ, about 17% a year since 2011. Okay, so the NASDAQ, because it's a secular technology trend, outperforms. Makes sense. And then you've got the bizarro world of Bitcoin, which is 150%. Gold actually doesn't beat it. Gold's about 8 or 7. So it's you're actually worse off in gold than you are owning the S&P 500, which is why that ratio keeps moving. So Bitcoin makes such a dramatic difference. Yes, so if you think about an aging population, if you think about your parents, the older they get, the less they spend. So aging populations tend to have lower trend rates of GDP. They all do. It's happened observable everywhere because old populations spend less. They also tend to not know how long they're going to live for after they retire. So when my dad retired, his spending must have fallen 60 or 70% because he's like, well, I've got this much money. I don't know how I'm going to live for. Is my wife going to be taken care of? And so they change their habits. And so that drags down GDP growth, as does debt. And so it keeps compounding this whole thing. Is right now, for example, interest rates are at 5.5%, but trend rate of GDP over the last 5-6 years is about 1.75%. So you've got this big gap and you need to get interest rates down so you can refi them, but all the time, GDP keeps falling over time. And you can forecast it into the future. It's just the births, deaths. And it gives you 30 years of understanding. And it's just telling us, unless something dramatic changes, which is technology, we're just going to keep dragging down GDP forever. And we're seeing it worse. Older populations, Japan, China, most of Europe, they're older than the US because they had less immigration. What you find is their GDP keeps shrinking. Australia, on the other hand, has a high immigration rate, as has Canada, and they tended to do better because of the immigration rate. Because really, GDP growth is driven by population growth, productivity growth, and debt growth.
Bitcoin gained 4% between August 21 and August 22, and despite losing some momentum, it has sustained the $60,000 support. Some analysts argue that a break above the $62,000 resistance is necessary to confirm a bullish trend. However, given the market's confidence in the United States Federal Reserve, Fed, implementing expansionary measures, the odds still favor Bitcoin bulls. Bitcoin analyst and investor Decode believes that BTC's price must break above the 200-day moving average, especially at the monthly close, to resume the bull trend. However, Decode adds that Bitcoin seems to have lost momentum for now. So, September looks most likely a continuation of the boring zone, but I am bullish on Q4 and ready to be surprised. In essence, investors remain bullish for the medium term, but do not foresee an immediate catalyst to close the gap between Bitcoin and traditional markets. Investors anticipate that the Federal Open Market Committee will cut interest rates at the next meeting, scheduled to conclude on September 18. Some economists believe there is potential for a 0.5% rate cut, which would be considered aggressive and typically favorable for risk-on markets. Such a cut would lower the compensation for fixed-income investments like U.S. Treasuries and reduce the cost of capital for companies. Even a 0.25% rate cut would signal to the market that the most severe phase of monetary tightening is behind us.
What you've got to understand is for each 1.5% of earnings growth, assets are going up by 10%. So each year, you can buy less and less assets. Now, what is an asset? An asset is future deferred consumption, whether it's for use yourself in retirement or your kids or whatever it is. But it's a saving of wealth that needs to grow to compensate for how long it's locked up for, and therefore your future self is protected. It's your wealth. And if it grows enough, you make a lot of money. But the issue is, everybody's future self is getting poorer because every year you can't afford as much assets. Right. And so therefore, all of these millennials are just finding this in front of them that they can't buy a house anymore. They can buy less of the S&P. It's just a really messy, ugly situation. And we saw it in 2022 as well. So the moment the markets go down a certain amount, the liquidity comes back. Even though the Fed was still tightening and they were doing quantitative tightening, the actual liquidity started picking up at the back end of 2022 because they're like, enough. We don't want the S&P to fall more than, let's say, 25%. And that's kind of a line in the sand that we've seen repeatedly, that every time it starts to get a bit wobbly, magic of liquidity comes back, they debase the currency, and everybody's okay again. Because if you think of the other big liability out there, we talked about ordinary people. Ordinary people do have a pension. And those pensions are in these assets too. And you've got this massive cohort of people that if you let the pensioners lose 50% of their wealth at what average age of baby boomers, average age is what, 71, 72? Well, that's going to destroy consumption because there's 76 million of these people. So they don't want to do that too. So they're between a rock and a hard place. And I ask a lot of people who complain about what's going on, and rightly so, is what would you do different? Are you going to default on all of the baby boomers and destroy their pensions and then destroy the entire economy? Or do you let all of the system go under because you don't have any assets? It's very difficult to actually come up with an answer that is reasonable. They're all shit. They're all shit answers. So maybe the least shit is 8% a year.
Some traders might note that the S&P 500 is trading just 1% below its all-time high, and even gold, often considered the world's most reliable store of value, reached its highest ever mark on August 20. In contrast, Bitcoin remains 16% below its June 2024 historical high of $71,943. This discrepancy partly stems from differing risk perceptions. Stocks offer a cushion through dividends and strong balance sheets, while gold is viewed as a hedge. Meanwhile, Bitcoin continues to struggle to establish itself as an uncorrelated asset that serves multiple purposes. For example, global gold ETF hold $246.2 billion in assets under management, according to gold.org, while spot Bitcoin instruments, including ETF and ETNs, total $66.6 billion, according to CoinShares. Despite Bitcoin's intrinsic properties of censorship resistance and a fixed monetary policy, it still has a long way to go to solidify its presence in traditional financial markets. This disparity in risk perception explains why gold's rise to $2,531 was not mirrored in Bitcoin's performance. While investors are certainly concerned about the U.S. government's fiscal debt and are seeking protection in scarce assets, most are not yet ready to fully embrace an independent digital currency. However, recent inflows into spot Bitcoin ETFs suggest a promising path forward. These instruments captured $226 million in net inflows during the 4 trading days ending August 21, indicating growing interest once initial barriers are overcome. Do not forget to subscribe to Bitcoin Seller. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.